welcome everybody. Thank you all for joining this afternoon. If any of you have joined any of Mariner's webinars in the past year or so, you may have seen my face before. My name is Jude Grimalidi. I am typically your designated host here for these Mariner webinars. And today's session is all about year-end planning. So we have an esteemed group of panelists here today, all colleagues and employees of Mariner, Ben Voelker, Jodi Robinson, Szalga. I'll do a little introduction after the fact here, but I just wanted to go over a couple housekeeping items before we do jump into things. If anybody does have any questions at all throughout the session, we do want this to be as engaging as possible. So there's a Q&A feature at the bottom of your screen there, so you can feel free to submit any questions there via chat, via the Q&A. This recording will also be available on the Mariner website. You can honestly just Google Mariner Wealth Advisors webinars, and I believe the top result there will bring you right into not only this webinar, but all of our previously recorded webinars as well. And so that should be posted, probably not today, usually within a couple of days. That way we can kind of iron everything out and make sure that from a technology standard, we have everything taken care of. All right, so I will go ahead and jump into things. So as I mentioned, we do have a great group of panelists today. First, we have Ben Voelker. Ben is the Director of Wealth Strategy, and he is a subject matter expert on estate planning. So we wanted to make sure that throughout this, this year-end planning discussion, we had subject matter experts from all different areas of the planning conversation, the planning life cycle. So along with Ben, we have Szalga. He's a director and senior wealth advisor. So he is going to be our subject matter expert on really the wealth management side of things. And then also we have Jodi Robinson, and Jodi is a managing director for tax planning and preparation. And so she is going to be our subject matter expert for taxes. So we will go through, a series of different questioning here that we have for our three panelists, and hopefully we'll be able to get, any of your questions answered as well. And this topic is something that I really like, especially this webinar. I did this webinar last year, and it's probably my favorite of the year just because the conversation tends to be so great. And year-end planning is such an important piece of the planning life cycle because it happens every single year. And there's so many different aspects of that planning conversation, so many different factors within wealth management and within planning that have some time-specific needs that need to be addressed, especially during this time, during end of year, especially with recent policy changes, with the different elections, and just with everything that is happening within the market. This is going to be a really great conversation today. So let me stop sharing my screen here. All right, so we can go ahead and jump into things. So while we're talking about policy changes and the market and the climate of everything that's happening recently, I'll direct this first question at Jodi here. So what is really the latest update on tax legislation changes in Washington? Can you share a bit about what we know or what we don't know?
Yeah, certainly. What we don't know is a lot as far as what may be happening on the tax front at this point. I think everybody's keenly aware that things are still in limbo in some of the elections. It looks like we're going to continue to have, division in DC. So from a tax perspective, that kind of sets us up to expect that we're probably not going to see sweeping tax legislation taking place. I mean, definitely nothing sweeping taking place before the end of the year. Right. And over the next 2 to 3 years, it's going to be a struggle for any particular party to get significant legislation pushed through. So right. the Republicans want to make the TCJA Tax Cuts and Job Act of 2017 permanent. It's set to expire in 2025. And the Democrats would like to let it expire and then make their own tax law changes. So, I mean, I think over the next few years, we're going to see some proposals out there, but it's of course yet to be determined, but not really expecting a lot of significant things to happen, at least in the next couple of years. Maybe starting to set the stage for 2024, when things are really going to start to get serious on the expiration of those.
Definitely. And that sounds about right. There's always so much up in the air as far as policy changes go, and so many things can get proposed and then end up getting pushed off the table after the fact as well.
Right.
One thing, Jude, that I bring up with my clients, and thank you for that, Jodi, is that, Jodi mentioned division in DC, status quo, which, from a political standpoint, not making, any opinions on that, but from a market standpoint, that status quo is usually good for the markets historically, right? That kind of division and not either one party not being able to kind of push their weight around, right? So although that, may not, align with some folks' political ideas, it's usually a good thing for the market. So, historically after midterm elections, the market does have a little bit of a rally. So hoping to see some of that for the end of the year here. It's so far been a good fourth quarter of the year for us.
So on that same line, Ben, I'll ask you the same thing from an estate planning standpoint or estate tax planning. Is there any considerations that we should be thinking about?
And Jodi hit the nail on the head. There is so much that we don't know right now. In fact, in my home state here in Arizona, we're still counting ballots as we speak. But there is one thing that we do know as it relates to the gift and estate exemptions, and that they are increasing year over year from this year, 2022 to 2023. So the exemption amounts, which is basically the amount you can transfer tax-free to heirs, is increasing to $12.92 million next year. From just over 12 million this year. Also, for those of you that may be doing annual exclusion gifts, which is your freebie that you can give to as many people as you want every single year, that number is also set to increase from 16,000 where it is today to 17,000 going into 2023. So despite the uncertainty broadly, there are some known factors as it relates to tax law going from 2022 into 2023.
Right. So with that exemption going up, what would you recommend, or not necessarily recommend, but what should people be considering as far as changes to their estate plans or just changing to the plans in general?
Sure. I mean, if you look at the history of the estate exemption, when I graduated college in 2002, it was $1 million per person. It's much higher than that now. But as Jodi mentioned in her comments, if the Tax Cuts and Jobs Act sunsets, it would go down to probably around 7 million. We don't know for sure because there's that inflationary adjustment per person. So we're in a pretty unique spot, a pretty pro-consumer landscape. So there's two ways really that you can take advantage of these all-time high exemptions. And the first, and it's really not recommended from a planning perspective, is you could pass away in a year where these exemptions are high. I've yet to meet a client that I've worked with that is thrilled with the idea of dying for tax planning. So we look at the alternative, and that is considering, making a gift into trust or directly to your heirs, which will lock in these higher exemption amounts. I know, we've had a poor year as far as capital markets are concerned. Real estate values are down, and I think emotionally it may be hard to think about things this way, but lower asset values actually make great assets to consider gifting. And so the ability to remove that asset from your estate and hopefully that future appreciation can be compelling. So as we're thinking about what do we do now in the landscape that we're in, the idea of making some of these larger gifts for families that it fits within their overall financial plan is certainly something worth consideration.
Yeah.
And we in our call or in our discussions before this call, we talked about the fact that, in 2017, 2025 seemed a long ways away, and people kind of got into the rhythm of feeling like, well, still have time to do things. Well, we're at the end of 2022 and it's upon us. So I think, what we are encouraging people to do is start somewhere, get a short-term plan to start getting things gifted out of your estate. It doesn't all have to be done in 1 year if you don't think you can chew off that big of a nut, but start somewhere.
Yeah.
Well, and human nature is to let things last till the last minute. But if you're going to be in a large pool of people that are trying to take action in the fourth quarter of 2025. So beginning these conversations, getting that future appreciation outside of your estate, one, there could be more compelling gift and estate tax savings by doing it now versus later, but you're also saving yourself the stress and the heartache of trying to do this with thousands of people in the fourth quarter of 2025.
Right. Ben, you mentioned something earlier that I just want to touch on, not necessarily asking any questions to anybody, but you mentioned the emotional side of things, and I just wanted to pinpoint that out just for something, just food for thought for everybody, because the emotional side of planning is something that is becoming so much more prevalent. And even just the CFP board just passed a new requirement for understanding the psychology of financial planning. And I just think that that is something that is so important because it impacts the decisions that clients make so much more. That's one of the reasons why it's great to have advisors, is just because they can kind of become an unbiased second set of eyes on things. But that is something that I would recommend everybody just looking into a little bit, is how the emotions and psychology of just human nature can really affect the decisions that people make as far as financial planning goes.
That's a good point, Jude. I always tell my clients, and it might not sound like a great thing off the bat, but I'll always say, as your financial planner, I'll never be as emotional about your money as you are as my client, right? And that might sound a little harsh, but that's a good thing, right? You don't want your emotions to be directing the strategies that you're embarking on, right? So exactly. I think that's a really great point and something to consider.
Awesome. So shifting gears a little bit, still walking the line with different tax advantage strategies and whatnot. One of the things that I see a lot, I work with advisors every single day, on how to implement different plans inside of their system. So I see a lot of different plans, and one of the most common techniques and strategies I see are Roth conversions. So Jesse, I'll direct this about you. Can you share some suggestions on how to know whether or not a Roth conversion would be a good idea?
Yep. Yeah, so Roth conversions in this environment are a phenomenal idea, and that spans the gamut of most folks actually. A lot of times the conversation is hard, right? Because clients, anybody really hates paying taxes, right? So when you're doing a Roth conversion, you're typically going to have to prepay some taxes, but that being the case, it can still be a really good idea, right? And an important thing to remember, we're talking about the Tax Cut and Jobs Act. There has been some legislation on the table to potentially get rid of Roth conversions, right? Going forward in the future. So at this point, everybody can still do a Roth conversion, right? No matter what tax bracket you're in, you can still use that technique. So it's definitely something to think about, definitely something to talk with your planner about. But is it a good idea specifically for you? Some things that I think about are, the tax arbitrage, right? What are today's tax rates versus future tax rates? It's our opinion that we're in historically low tax rates, and going forward, tax rates are probably going up, right? Nobody likes to hear that, but that's probably the case, right? So it could make sense to do those conversions now, pay less of a tax now than you would in the future, right? So looking at those tax brackets is a big consideration. On the state side, there are some states where they don't have an income tax, so you can do that Roth conversion without paying any state tax at all. So that's in those states it's exceptionally a great idea. And then there are some states that do have income taxes, but they don't tax retirement income, right? I'm in Illinois, and that is a state where we don't tax retirement income, at least not yet. So good idea there. Down markets, right? That's another phenomenal time for Roth conversion planning. And the reason for that is, moving the money from your IRA to where you're eventually going to have to pay some ordinary income taxes, to doing that now, where that exponential growth hopefully is what we get here going forward after a down market. Who knows when that'll be? But if that can occur in that Roth IRA, that could not only be a good benefit for the individual making that Roth conversion, but also for the beneficiaries and the heirs down the line. Because with a Roth conversion, if that's an account that you inherit, you're not having to distribute that out within the new 10-year rule, which we'll talk about on a yearly basis, right? So you have the full 10 years before you have to take that money out rather than having to do it right away. So that's a neat little thing for your beneficiaries. And I think Ben's going to talk a little bit more about that for us in a little bit here. But another thing that I would mention on top of Roth conversion planning is what we call the backdoor Roth conversion. And some people, call this a tax loophole. But it's some clients think that, hey, I can't make Roth conversions, right? I make too much money. Well, that's not necessarily the case, right? There's an opportunity to do something called a backdoor Roth, and Roth contribution limits are actually going up next year. So again, another important thing to consider. And even going further on that, there's something called a mega backdoor Roth. So clients could potentially make Roth contributions, even if their income is too high, through a 401k plan. Now, again, I'm not going to get into the details of that because it can get a little bit complex, but those are two other strategies to potentially think about outside of just doing the normal Roth conversion.
And I think one of the things that, just to reiterate, a lot of these things are very particular to your situation. And one of the things that we encourage you to do is reach out to your advisor and work with them. If you think this is something that, may be good for you, the advisor teams can run some different models. We're not saying that this is ideal for everyone, but if your particular situation in this year fits parameters, it could be a fantastic thing for you to think about. So, Jesse is totally on point. There's a lot of different things that you can do with Ross that will put you in a fantastic position going forward once the market goes back up.
Yeah,
that's a good point, Jodi. And I want to reiterate that, we don't just make that blanket, hey, do a Roth conversion. It's a great idea, right? We sit down with all of our clients and model that out. So show exactly, hey, we are going to have to pay this amount of tax, but this is what we're projecting for the future that this will look like, not only for you, but also for your beneficiaries.
Yeah, definitely. And, Jodi made a great point that not everything, and this is just good for this entire rest of the conversations that we're going to have today, but not everything that we talk about is going to be applicable for everybody. Everybody's situation is different, and everybody's situation can change on a day-to-day basis. There's so many things that can happen that can impact the way that your plan goes. So, these are just really food for thought for you. So make sure that, if your advisor hasn't brought these things up and it does sound interesting to you, then bring it up to them. And a lot of the times that they might not be applicable to you, which is why they didn't bring it up. So, it's not always going to be applicable to your situation at hand. So keep that in mind. All right. So another topic that's important that I see a lot, and especially as it pertains to year-end planning, and Jesse, I'll just continue with you on this one as well. RMDs, so required minimum distributions, that comes up all the time, whether people are getting a little bit older in retirement or whatever it might be. These are things that you need to make sure that you're considering from a cash flow standpoint in retirement. So are there any things that you think folks should know about in regards to the RMDs?
Yeah, there's a lot to know about RMDs. I think the first thing to know is make sure you take them, because there's a 50% penalty if you don't. So I think that's one of the most important things. And of course, we help make sure our clients, are taking those before the end of the year. So, one of the unique things before I get into some of the bigger picture items on RMDs is what I do for a lot of my clients, who are small business owners or for whatever other reason need to make estimated tax payments on a yearly basis. One of the neat thing about an RMD is you can actually withhold your RMD amount and just send that directly to the feds or send that directly to your state tax authority and use that as withholding, right? And the neat thing about that is that, at least on the federal side, the feds, they count that as being as paid in equally throughout the year, right? So that's one neat little trick that I think a lot of folks don't know about. So if you think you've under withheld this year for whatever reason, or you have a big income item in the fourth quarter here and you still have your RMD, you can use that RMD to help alleviate some of those taxes and avoid potential penalties and interest.
Sure.
But anyhow, who has to take their RMD? Well, again, with some legislation that was called the Secure Act passed in 2020, the RMD age was raised to age 72. So, you do not have to take your RMD now until age 72. It was age 70 and a half prior to that. For the most part, you need to take it by the end of the year. You can wait until April 1st of the next year, but then the important thing to remember is that you have to then double up, right? So you'll have to take two RMDs, the one for the prior year and the one for the current year. So there is some times where, folks may ask, well, why would I do that? When does that make sense? Well, if you think that for whatever reason, you're retiring this year, if you had a big income event, sale of a business, again, is another good, easy example. Well, next year might be a smaller income year. That could be the right year to do that RMD, right? So sometimes doubling up does make sense. And another important thing I think to point out about RMDs is if you're still working, you do have to still take an RMD from your IRAs. However, if you're not more than a 5% owner of the business and you still have your 401k, then typically you don't have to take that RMD. So one technique that I use is I'll move an IRA into the 401k, right? So then we can avoid having to take those distributions. So another little technique that I'll use sometimes around RMDs. But again, taking it is important. There's a big tax penalty. Now it's age 72. There's something out there, some more legislation. They're calling it the Potential Secure Act, I think 2.0, that would further increase the RMD age. So there's potential that they're going to increase that even further as well. So, that's something that we're continuing to keep an eye on. So that's just regular IRA RMDs. For Roth accounts, as I mentioned earlier, you don't have to take those. The rules are different for inherited RMDs. So I think that's something that's important to mention as well. So pre-2020, pre-Secure Act, there was something called stretch provisions. You can take those RMDs over your lifetime. Now you have to take them, within that 10-year time period. And there is a little bit of confusion as the IRS is again proposing some legislation of what that needs to look like if you've inherited an IRA. That, again, without getting into too much detail, it was initially thought that maybe you could just wait the 10 years and then take the RMD at the end of those 10 years. But now it looks like the IRS is going to be saying that if, the decedent, the person who passed away, was already taking their RMDs, the beneficiary will also have to start taking those RMDs. But again, we're said to have final legislation for that in 2023. If you've inherited an IRA, in 2020, 2021, or 2022 and didn't take those RMDs, the IRS is saying that's okay. Don't worry about it. You don't have to take that. But again, we're keeping an eye out for the legislation going forward. So again, just to reiterate on the inherited IRA, you got the 10 years to make those distributions. With the Roth account, it's a little different. Again, as we have the final legislation, hopefully coming out sometime next year, we'll get a little bit more clarity. But it's looking like with that one, that beneficiaries will have the full 10 years before they have to take the dollars out of that Roth.
Yep.
So I think those are the important points to consider, Jude. I don't know if Ben or Jodi have anything else for us there.
So I'll kind of direct this at Ben, actually. So from folks that are more charitably inclined, so if we're thinking about charitable donations, how do RMDs play into the estate planning conversation as far as charitable donations go?
Sure. And I've always thought traditional IRAs and charitable contributions work well together. The IRA is all pre-tax dollars. Charities are tax-exempt organizations. So early in the 2000s, something was introduced in the tax code called qualified charitable distributions. And for a couple of years, the IRS kept extending it, but they would do it late in December and everybody would rush to get it done. It's now a permanent fixture in the tax code. And what that qualified charitable distribution allows is for any IRA owner that's over 70 and a half, they can direct up to $100,000 from their IRA to a charitable beneficiary, and that will be used to satisfy a portion or all of their required minimum distribution. And by directing it from the IRA to charity, the IRA owner will not have to recognize that income from the distribution. So they don't get a corresponding charitable income tax deduction, but they're able to avoid the income, which almost always is a better tax event for the taxpayer. Again, everybody's a little bit unique and different, but more often than not, being able to avoid the income is more preferable. The other idea around IRAs and charities that's gotten a lot more popular since the passage of Secure, Jesse just mentioned that for most beneficiaries, non-spousal beneficiaries, the payout from a traditional IRA has to be taken over a 10-year time period. One strategy that we've seen employed is that families will create a charitable remainder trust, and that trust will become the beneficiary of the IRA. In an easy example, if you have an IRA worth $1 million and a charitable remainder trust is the beneficiary, the IRA owner dies, that $1 million goes into the trust, and there's no immediate tax liability. So the entire $1 million can be reinvested. The beneficiary, which is typically the child of the deceased, gets a distribution for the rest of their life. That distribution has to be at least 5%. And the maximum is a mathematical formula based on the age of the beneficiary when they inherit, as well as some assumed interest rates that the IRS give us on a month-by-month basis. The distribution of income, minimum of 5, maximum something higher than that, that will carry out the $1 million of ordinary income tax over time, but we're not limited to that 10-year window. Once the $1 million of ordinary income has been fully distributed, then it's possible that a portion of those distribution to the child beneficiary will be tax-free at that point in time. At the end of the child's life, whatever's left in that trust does go to a charity, can be a donor advised fund or something that's family controlled, or can be your favorite charity. But if you have charitable intent and you're thinking about how to maximize that distribution to your heirs, but ultimately benefit charity, using that trust structure as the beneficiary of the IRAs as a way to extend past that 10-year time horizon and then ultimately fulfill your philanthropic intent. So I could count on one hand the number of times I saw that done prior to Secure in 2020. Now it would take both hands and both feet and then some for the number of clients that we've worked with that have employed that type of strategy. So just something when you're thinking about beneficiary designations to keep in mind if you have larger balance retirement accounts.
Mm-hmm. Yeah, I've been with Mariner for a little under 2 years now, and that is something that I see come up a lot more frequently as time goes on. So
I would add one other quick note from an income tax planning perspective on the QCD. I think that's sometimes underutilized as a tax planning tool. Using that at appropriate times, could lower the tax rate that you're paying. It could impact the capital gains rate that you're paying if you're managing your AGI. Allow you to itemize some more deductions, and even, keep you below the net investment income tax thresholds in some instances. So I think, it's something that more people who are charitably inclined, of course, you've got to do all of these, package all of these up for the right reasons, but I think it's an underutilized tool in, managing some of the tax implications as well.
Right, definitely. So Ben, I'll ask a little bit more. So kind of moving off of the charitable side of things and just in general, estate planning and wealth transfer standpoint, is there anything else that you think people should be considering just from a general wealth transfer standpoint? It's a vague, open-ended question, so I'm sure there's a lot, but.
Well, I'll take it back to our conversation about the exemptions and where they are. And so, when you think about it at the end of the day, there's 3, maybe 4 main places your wealth can go. It can go to your heirs, it can go to charitable beneficiaries, it can go to the IRS, or you can spend it. And maybe for next year's year-end planning, we can have my wife on because she's an expert in the 4th category of spend. But so you're thinking about where, for your family, what buckets do you want to fill most effectively and most appropriately? And so going back to the idea of making this gift of the 12.06 today going to 12.92 next year, I think it sounds great from a tax planning perspective to say, all right, I'm going to give away this wealth. I'm going to lock in these higher exemption amounts. I'm going to maximize what goes to my heirs and what goes to the IRS. But the fact of the matter is, not all of us, myself included, are in a position where you can comfortably give a little less than $13 million per person, or a little less than $26 million for a married couple. So some of the structures that we're seeing used to receive these gifts are designed to create maximum flexibility. And so the vehicle that become the most popular is what we call a spousal lifetime access trust. And in estate planning, we come up with these stupid acronyms for pretty much everything. We call this SLAT. But in a structure like this, one spouse, presumably a husband, would gift into trust for the benefit of his children ultimately, but his wife would also be a beneficiary of that trust. And so if the assets that husband and wife retained were not sufficient or were not liquid for their needs later in life, there's a mechanism to make a distribution from these gifted assets in the SLAT back to that spousal beneficiary, and then ultimately return to husband and wife for their use and enjoyment. There are rules and requirements, obviously, on how these things have to be structured, and making sure that there's a disinterested party to make those distributions to the spouse. But it's a way for us to lock in these higher exemption amounts. But at the same time, we've created a bit of a safety net, where if something unexpected happens in our personal life, there is a mechanism to return some of these funds back to the individuals creating the trust. Mm-hmm. The other really common structure that I see around these gifts is a lot of the clients that we work with, and probably many of the 200 plus of you that are on this webinar today, you're type A. And the idea of making a gift is compelling, and the math behind it works. But the idea of relinquishing control on how these assets are managed is unappealing, especially if we're looking potentially at an asset that we're giving being an interest in a privately held business or in some family controlled real estate. And so we see a lot of directed trusts. And there are certain states, South Dakota, Nevada, Delaware, that have advanced planning statutes that have been built and have been tested with case law, where you can make a gift into trust for the benefit of your children, but you can retain the role of investment advisor, and in many cases, even distribution advisor. So you're still controlling how the assets inside of that trust are managed. You can, to a degree, participate in how those assets are being distributed out to your heirs as the beneficiary, but the IRS is comfortable because you have a third party, typically a South Dakota or Nevada or Delaware-based trust company. They're comfortable that those assets have been effectively moved from your estate. You've given up enough control using that state-specific statute. And you don't have to live in South Dakota. You don't have to live in Delaware, but you can utilize these alternate state statutes in order to build a plan that's got maximum flexibility. Flexibility to get the assets back to you and your spouse should you need it, and flexibility to retain the maximum amount of control over how these assets are managed and distributed in accordance with appropriate law. And so when I think about what you should be doing, that estate tax, change or potential change in 2026 is just so impactful. If your financial plan that Jesse or one of his peers has helped you develop, if you look at it and say, yes, we can afford to gift, some of those structures are going to be the most appropriate so that we don't end up with a situation down the road where your kids are multimillionaires, but you're making ramen noodles for dinner because you don't have enough left in the bank.
Jude, one thing I'd point out on that as well, and thank you, Ben, that was a lot of great information there. Ben brought up a good point about, hey, well, I don't have $13 million, or between me and my spouse, we don't have $26 million. One thing that I would mention is that, at least here in the state of Illinois, we have our own estate exemption, right? And that number is much less than the federal level, right? It's at $4 million. So I think another important thing to keep in mind is, not only that federal exemption, but also what are the state exemptions? Because those can be much less. And I know there are states out there that are even less than Illinois' exemption.
Yeah. And I think that, that's a great point, is that there are so many different laws that are so different across the entire country. So again, not everything is going to be applicable to everybody. But, if you there are advisors obviously in every single state, and we at Mariner have a network of estate attorneys in every single state as well. So there's tons and tons of resources out there that are really going to help direct you to where you need to be for whatever the situation that you're in. Whether you're in one state now and moving in a future year, how things might change in that front, or even just how they stand today. But I think that's a really great point. So Jesse, I will direct this at you again from just a wealth management standpoint. Is there anything else that people should be considering, like whether it's, let's say, education planning, because that's one of the things that I see happen a lot, or just general gifting? What do you see from your side of things, or things that people should be considering either before end of year or just in general?
Yeah, well, in terms of charitable planning, things to consider, the timing is important, right? So, the deduction that you receive, for the most part is the marginal tax bracket that you're in, right? So we're looking at tax years. Is this going to be a higher tax year than next year? Is it not, right? So there's some things that be taken into consideration from that tax perspective, right? And then with the way that the tax law is right now, again, as we mentioned with the TC, with the Tax Cut and Job Act, TCJA through 2025, right now the standard deductions are much higher, right? So, and it's harder to meet that itemized deduction, right? So, there are clients that may be very, very charitable, doing right $10,000, $15,000 per year in charitable contributions, and not getting any benefit out of that, right? So there are some techniques and things to do, such as bunching your charitable contributions, right? And I think we might get a little bit more into this with donor advised funds potentially, right? So there are techniques out there where, you can be making your charitable contributions, you put them into a fund. You don't necessarily need to dole all that money out to the charities now, but you could take advantage of that tax deduction now, right? So I think the timing is important. The way you're gifting is important as well. And I think we're going to cover some more of those pieces here in a few minutes.
Yeah, definitely. So, Jodi, I'll direct a question at you as well from your standpoint, from a tax side of things, whether it's charitable planning or just things that we should be considering before year end. What input do you have on that?
Yeah, I mean, this time of the year, we see a lot of activity on the charitable planning front. As Jesse mentioned, a ton of activity in donor advised funds, just because people can make that contribution, get the deduction this year, and then figure out over the next few years where they want to donate it. Another charitable strategy is identifying the most tax advantageous charitable asset to donate, which may not be cash in a lot of instances. I think a lot of people just get conditioned to writing a check, and really what we can help you do, your advisor team, is identify what other assets might get you the better tax deduction. Likely it's going to be an asset. It could be an asset in your portfolio that you've got a lot of unrealized gain in. So you're sitting on an asset with very low basis and a lot of future gain to be recognized, which means you would be paying tax on that. If that is an asset that can be identified, that asset can be donated to charity. You get the deduction for the fair market value, and you've moved that unrealized appreciation out of your estate and avoided paying tax on it at the same time. So I think, as you get towards the end of the year, don't always just default to writing a check. Maybe think a little more strategically about what you have in your portfolio that might get you a better tax deduction as well.
So moving off of charitable planning a little bit, just from a general tax planning standpoint, and you talked a lot about the assets that people have. When we're thinking about all these different types of assets, whether it's retirement accounts, it's like a HSA and FSA, just different assets in general, are there anything that people should be considering?
Yeah.
Again, either now or before year end?
Yeah, definitely. Tis the season to kind of start to button up your tax planning, whether that's capital loss harvesting. We talk about that a lot. If you have losses in your portfolio and you may have gains in another section of your portfolio, or gains outside of your portfolio may be more likely this year, whether it's, you sold a second home, or you had a sale of a business, those losses that you're harvesting from your portfolio may be able to offset some of these other gains that you would be, looking at paying tax on outside of that. So definitely taking a look at your overall situation and figuring out whether there's some losses out there that you can realize now to help offset that. Max out your HSAs, max out your FSAs, max out all of these things that are going to give you the tax deductions through your employer provided vehicles, right? I mean, a lot of these are employer provided vehicles, your 401k. If you have not yet maxed out your 401k, take a look at, whether you have the opportunity to do that between now and the end of the year. You can always adjust up and down for those types of things. Take a look at your pay stub withholdings. We're getting close to the end of the year. Work with your advisor or run a projection on where you think you're going to be from a tax perspective. And if you need to maybe adjust your federal or state withholdings to get you to a better spot, up or down. So, now's the time to be doing some housekeeping on the tax side for sure.
Yeah.
One other item I would mention to Jude is 529s, right? So that's another potential place to be funding before the end of the year. Ben brought up the annual exclusion gift for us, so do keep that in mind as well when making gifts to 529 plans on behalf of children, grandchildren, whoever it may be. It is important to point out that if you're making gifts directly to an educational organization or for medical expenses for another person, that annual exclusion gift does not apply, right? So you can kind of make unlimited gifts if you're paying directly to the school or for the medical expenses. Another neat thing is for 529s, regarding the annual exclusion, they do let you pre-fund those for a 5-year time period. So if that's something you wanted to do this year, you can take that $16,000 times 5, and you can make an $80,000 contribution into that 529 plan. So you can't do it for the next 5 years then, though, for that individual. But that is a neat way to kind of start bringing down that estate, right? Because once those assets are in that 529 plan, they are out of your estate. With some of the new legislation that we have here recently, you can also now use 529 plans for K through 12, right? So each calendar year you can use up to $10,000. You can also use them to help pay down student loans, which is new. That used to not be the case. That is just a one-time, one lifetime up to $10,000. So that's not something you could do on a calendar year, at least at this point. But I would say that's an important account to think about funding. Some states do offer a tax deduction as well for making those contributions. And again, the neat thing about those 529s is you get that tax-free growth. So of course, the earlier you can do it, the better. I mean, as long as it's used for educational expenses down the line, no income tax is paid on that once you withdraw it.
Yeah, I think you bring up a good point of the student loan side of things. That is obviously a conversation that is being had a lot more nowadays in the current climate, and with the student debt relief that is being proposed and everything along the lines there. That's obviously, student loans are a conversation that are a topic of conversation at all points of time, but now more than ever. And I think that was a really great point to mention, that the new 529s being able to pay off those student loans. So we're nearing the end. We have about 14 minutes left here, and I do want to make sure we get to a couple of the questions from our audience here. So I'll ask just a couple more, maybe one to each of you, and then we can jump into some of the other questions that came in. So Ben, I'll direct this first one at you. Do you just have any other recommendations? I asked the same thing to Jesse and Jodi, as far as timing or common mistakes that you see being made, or whatever it may be.
Yeah, I mean, here's what I'd say, and this is kind of end of the year, beginning of the year, but new year, fresh start, right? Gyms are packed, alcohol sales are down, junk food's still on the shelf, everybody's got a new beginning. Use that as an opportunity to revisit your estate plan. When's the last time you updated it? Has it been more than 5 years? If it has, you're probably due for an update. If you've set up a revocable trust in states where that's the common planning vehicle, have you titled your assets correctly? Take a look at all of your beneficiary designations, whether it's retirement accounts, annuities, life insurance. So many times we have clients that put all of this protection inside of their trust or inside of their will, designed to control how wealth is distributed to their heirs for a variety of reasons. But then their largest asset, a life insurance policy or their IRA, just pays to the kids or grandkids directly. And so the beginning of a year is a great time to kind of pull out the binder, dust it off, make sure what you have is what you want first and foremost, and then make sure all of the other ancillary things around titling and beneficiary designations fit with the overall plan. Just a great exercise to do on an annual basis.
Yep. Yeah, and I think you brought up a great point. There's a month and a half left towards the end of the year here. And so just make sure that you're reviewing everything that happened, whether it was in the past, let's say 5 years, the past year, so many things have happened. This is the perfect opportunity to just sit down and figure out everything that had happened over the course of this past year and how that could potentially impact whether it's decisions that you're making on your plan or if it's just a topic of conversation that you want to have with your advisor. Does anybody else have anything to add either there or just in general before we get to any of the other questions?
Energy efficient tax items, right? With the Inflation Reduction Act and things, start thinking about those, solar panels, cars, bunching potentially. I know we've been talking about, pushing income or expenses to certain years. So bunching medical, right? If you can prepay some certain things and, depending on your tax situation, that could be an idea. Sometimes we have clients potentially prepay their property taxes as well. So again, just some other ideas that can potentially, help save on some tax dollars before the end of the year here, if you were planning to do those things anyhow.
Sure.
And I would just say, I've always told my clients, as you're making these decisions for tax planning purposes or for tax purposes, make sure that you're looking at the whole picture and working with your CPA, working with your advisor. Don't let the tax tail wag the dog and make a decision for tax purposes that's going to have ripple effects in other parts of your life. So,
right.
Just be cognizant of that and working with your advisor.
Perfect. All right, let's just jump into a couple of the questions from the field here. One, I guess this one I'll direct at you, Jesse. I talked a little bit about the emotional side of financial planning and the psychology of financial planning. That gets obviously very personal. Do you find that clients are very willing to listen to that side of things, as things do get emotional? And, obviously it's going to be subjective, but what's your take on that?
Yeah, I mean, for sure. I mean, what do people get most emotional about, right? It's their money, right? So that's part of our job, right, as an advisor, to have those tough, difficult conversations with our clients, right? We don't shy away from those. As a matter of fact, we want to hear that side of things, right? So that's very important to us, right? The quantitative matters, right? I mean, the math answer matters, the tax answer, the investment answer, but the qualitative things matter as well, right? And sometimes from a dollars and cents standpoint, a strategy might make sense, but again, thinking about it from that emotional standpoint, for whatever reason, it may not. So no, that's just important. A lot of times, we amongst ourselves, we say that as financial planners, advisors, we're psychologists too, right? Especially during a year like this, right, where markets are difficult. So that's definitely a key component of kind of all planning things that we do, is considering that emotional side of it.
And I think that's especially true on the estate plan, Jude. Often I'm brought into a meeting, say it's Jesse and a client he's worked with for 10 years, and I'm meeting them for the first time. And 10 minutes into the meeting, I'm asking them questions about their kids and how they've matured as individuals, who they've married, and do mom and dad care for the in-laws? I mean, those are very personal questions, especially when you met me 10 minutes ago. but those are certainly very important for us to be able to provide the right level of advice and guidance around what the structure of the wealth transfer plan could and should look like to ensure that our clients' goals and objectives are met first and foremost. And so I feel like we're obligated to ask those questions and get those answers. Sometimes it's as challenging as those conversations can be.
Yeah, and to add to that as well, especially from a estate planning standpoint, you're talking about passing away, and that's a tough conversation to have with people. Especially as folks get older, but these are necessary conversations to have to make sure that your family and your next of kin are prepared and that everybody is in good shape for when that does happen. So one of the things that you talked about, that was the exclusion gift limit of $17,000 per person. Is that per person, or is that annual total?
So the annual exclusion gift, which is $16,000 this year, going to $17,000 next year, you can give that to as many people as you want, related or unrelated. So kids, grandkids, spouses of children, random strangers on the street, basically anybody who doesn't work for Mariner, you can give them $16,000 this year, $17,000 next year. And that repeats on an annual basis.
Perfect. Awesome.
And both spouses, I get this a lot. Both spouses can each give $16,000 to an individual, right? So you're not limited to just one spouse doing that.
Yeah. So we had a couple questions that came in on the Roth side of things. So with an inherited IRA, can you convert to a Roth and keep it more than the 10-year rule?
So you can't convert an inherited IRA to a Roth. You're just not allowed to do that. So then the whole 10-year rule doesn't necessarily apply. Perfect.
And then when you are looking at Roth conversions, recommending Roth conversions, you're looking at the total MAGI. Like, what are you?
Yes.
Really
Yep. Exactly. So there are certain things that, there's something called your MAGI versus just your regular adjusted gross income. There's the modified, municipal income and other things do affect that number. So yes, exactly. That's the MAGI typically that you're having to use.
Perfect. And then this one is a little bit more on the tax implications of things. So this folk asked, are there any tax consequences or advantages if I give my daughters money to contribute to their Roth accounts, either for is the advantage or consequences for them or for the daughters?
Yeah. So, I guess first and foremost, the daughters, the child would have to have earned income in order to be able to make a Roth contribution. So that's the first hurdle to clear, is the child actually has some income, and you could make a Roth conversion up to the amount of that earned income. And then second, if you're gifting the money to them, if they are eligible and you're gifting the money to them, it would just need to fit in whatever the annual gift exclusion is for the year.
All right. One of the other things I want to make sure that we touch up on that somebody just wrote in is keeping an eye on how Medicare premiums will increase during Roth conversions. Mm-hmm. So, there are a lot of impacts that this can have. And so just make sure that you are keeping an eye on that as well.
Yeah, that's
a good point. And I think that goes back to what Jodi was saying earlier about how, these strategies in and of themselves sound great, but you got to make sure that it makes sense for you. So as a planner, I'm always modeling that for my clients and saying, all right, we're going to jump to that third Medicare tier, but does that make sense? Is it still worth doing this conversion? So, yeah, great point.
Perfect. We do have a couple questions on QCDs. Is the definition of a child on the QCD under 18, or is it any age of heirs?
I know a lot of us think of our children as charities. I know I certainly think of my three as charities, but a qualified charitable distribution cannot go to an individual. It has to go direct to a charitable organization.
And it can only be made from an RMD.
Yep. So what are the tax implications of QCD at age 70 and a half if you don't take the RMDs until age 72?
Well, if you qualified for the RMD back under the old 70 and a half rules,
mm-hmm.
I mean, like I said before, the QCD has to come out of an RMD. So you have to be eligible or under the requirements to take an RMD in order to be able to do the QCD.
Basically, it allows you to reduce the amount of that IRA, right?
Yeah.
Before, having to take income as an RMD.
Yep.
Perfect, thank you. And then there's one more question that's here, and this is just on the RMDs as well. Do you have to take the RMD the year you turn 72, even if your birthday is at the very end of the year?
So as we talked about, you could wait till April 1st of that next year if you'd like, right? So with the old 70 and a half, there was some distinguish, do you do it at, the beginning of the year, second half of the year, depending on when your birthday was. But yeah, now it's the end of the year, or you have till April 1st of that next year.
Perfect. All right, does anybody else any of you three have any closing thoughts today for the group? Anything else that you'd like to add, or whatever it may be?
I would just say, make sure to reach out to your planner. There's a lot of great opportunities out there, and most of those opportunities have to happen before 12/31, right? I tell a lot of clients that a lot of times the CPAs that I see they're working with are historians, right? In March, they'll say, give me your tax documents and we're going to do your tax returns. Well, most of the time, if we're past 12/31, it's too late. A lot of the strategies, things that you should have been doing, you can't do anymore. Of course, there are a couple of planning items you can still do after the end of the year. But again, it's important to think about these things and get moving, because once that deadline passes, it could be too late.
I would also say that Mariner puts out an annual tax planning guide that gets updated every year. That is in the final stages of being completed. So be on the lookout for that, either via our website or via an upcoming newsletter to be able to access that.
Perfect. Awesome. That is a great point, Jodi. Go ahead.
And I think I'd just close by saying thank you to all who joined. Those who are informed tend to make the most informed decisions, especially when guided by a trusted advisor. And so we appreciate your time today and welcome the chance to continue to address the questions that you have as a firm.
Yeah, thanks, Ben. Stole my thunder a little bit there. That was the same thing I was going to say.
Sorry about that.
But thank you, everybody, for joining today. We really appreciate it. As I mentioned, if you had to join in later on, or if you want to send this to anybody, we will have all of the recordings on our website as well. I also want to thank you three, Ben, Jodi, Jesse, thank you so much for taking time out of your day to educate everybody here. I even learned a lot through this as well. So thank you all so much for your time. I really appreciate it.